Good morning and welcome to this Monday, May 24th, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, we've got some pretty nice futures at this point this morning. Looking at those futures right now, Dow Jones up more than 100 points. S&P 500 up more than 20, and the NASDAQ also up more than 100 points. So it does look like we'll get off to a fairly good start this morning. Earnings, not much going on anymore. We do have a few bigger reports later in the week. Nothing this morning really of significance. So the market just kind of trading on its own. We're going to get into some of those things in just a couple of minutes. Take a look at what's happened last week and take a look at some of the charts. But first, for those of you that are new to Earnings Beats, I just want to make you aware that we do have a free Earnings Beats Digest newsletter. You can simply go over to our website at earningsbeats.com and you will see it there. Just simply enter your name, email address, hit that subscribe button, and we'll make sure we get the digest out to you 3 times a week, Mondays, Wednesdays, and Fridays before the market opens, normally focusing on earnings, relative strength, things of that nature, things that we look at Earnings Beats, things that we think are really important, and I believe will help in your trading. So I just want to make sure that you are aware of that. Let's take a look at what happened on Friday as we closed out another month of options. Friday was options expiration day, and we had a webinar last Tuesday, which we always do. We always have it the Tuesday before the Friday when options expire. And I'd say that for the most part, things kind of went the way we would have expected and the way we did expect going into the end of last week. Usually what happens are the areas that haven't been performing very well tend to all of a sudden perk up, and those areas that have been leading suddenly can't catch a bid. And that's essentially what we saw last week with some of the worst performing sectors of late snapping back a bit toward the end of the week, and then those areas that had been pretty strong struggling as options expired. The Dow Jones Industrial Average on Friday finished up 123 points. The S&P down 3 and the NASDAQ down 65. Pretty big reversal off of a gap up above its moving averages. So that was a fairly significant failure. But we'll see what happens today. We do have futures, as I mentioned, up more than 100 points. We'll see whether or not we can hold that, whether we can clear the high from Friday. I think that would be a short-term positive. But simply staying above those moving averages is really what we want to see. I believe right now the NASDAQ is completely trendless. We've got all of these moves below the moving averages, back above, back below, back above, back below, now trying to get back through again. That type of behavior is trendless behavior. When you are trending in either direction, those moving averages don't get pierced like that frequently. We normally stay above for a period of time. So right now, I don't think what's happened to the NASDAQ has actually been that bearish. It was probably something needed after all of the gains that we saw in 2020. Just trying to predict exactly when you're going to see that sideways action is very difficult. But the NASDAQ's been through it and may continue. We don't have any signs at this point. If we break above, 13,750 or even 14,000, come back down, hit that 20-day, and then go set another high, that's what you look for in terms of trending. We have not really seen that. And you can see of all the major indices coming across here, I would say the one that's been the most in a non-trending environment is the NASDAQ. The mid caps up 6 on Friday, small caps up almost 6 as well. All of these, though, are consolidating. Every one of our 5 indices are consolidating. NASDAQ's just been doing it longer. Financials, I mentioned, some of the stronger areas struggled last week. Financials kind of in that category, although we did bounce on Friday. But during options expiration week, we did get a 20-day test. Utilities, a little bit more weakness here. As you can see, we topped back in April. Been struggling a little bit, but very normal during a secular bull market to see defensive groups underperforming. Industrials also had pulled back last week, but did bounce toward the end of the week. Still holding on to its 50-day moving average. All of these have. Now, when we look at technology, we see almost a mirror image of the NASDAQ. And for good reason, because the NASDAQ is tech-laden. We have a number of large technology companies, and they tend to direct the NASDAQ to a pretty large extent. But technology also in this trendless environment where you can see all of these moves up above the 20 and the 50. Another indication of trendless environment is when you see your short-term and long-term moving averages continuing to cross each other. Normally, if you're going from bull market to bear market, you see one cross. It's a death cross to the downside. You don't see it come back up again and then come back down again. So that's something that just tells me right now it's a little dangerous in the technology area. It continues to be a difficult area to predict. Short term, if we're going to go higher or lower, because we really have no trend. But I think further out, long term, I think we're still fine with technology. Similar picture on consumer discretionary with these crosses of the moving averages. You can see the 20 just going back below the 50 here at the end of last week. And now with the market strong this morning in pre-market, probably going to see price action move back up above these moving averages again, or possibly we'll see how the day progresses. 10-year Treasury yield. Let's get a quick update here. As far as the economic data goes, there's very little, if any, today. So the market, bond market, stock market is not really going to be moving based on economic data. It's simply going to be moving mostly due to technical information. And like I said, we're consolidating, so there's not a whole lot of that. The 10-year Treasury yield, though, down about 2 basis points this morning, 1.61%. Just continuing to consolidate in this 150 to 175 range. I really don't see anything else there. Financials and industrials, as you can see, the 10-year Treasury yield has been trending higher for months. And so financials and industrials, not surprisingly, are leading and breaking out recently to new 52-week highs relative to the S&P. So these are two of your stronger areas. And I would say they are your two strongest in the aggressive part of the market. All right. I wrote an article over the weekend. This was an article in Chart Watchers. And I just wanted to point it out because if you followed me for a long time, you know I do a lot of work with Excel. I track the market. I'm a historian. I find it fascinating. I don't do this because, I just feel like I have to. I do it because I really enjoy it. I like to see what makes the market tick. I'm fascinated by the fact that the stock market is driven by more than what you would think, which is just earnings and news. I mean, there's so many factors that drive the stock market. And from a short-term trading perspective, the more knowledge you have of those things, the better odds you have of outperforming the benchmark S&P 500 as a trader. So I put in this table, and it was really looking at the key run-ups in the S&P 500 heading into earnings season each quarter. So if you look at the numbers, and they're not the exact same in terms of number of days. Like, for instance, and some of this is probably the Santa Claus rally starting December 21st. Maybe it has nothing to do with earnings, but it's a really strong period heading into the beginning of earnings season. So I thought, okay, let's go ahead and take a look at these periods where we tend to see these run-ups. So December 21st to January 19th, there have been, and this is since 1950, there have been 899 days where the S&P 500 has finished higher, and 674 where we finished lower. So percentage of up days, 57.15%. There are your cumulative gains. So if one day of December 21st, 1950, we gained 1/3 of 1%. The next day we gained 1/2 of 1%. Well, I'm just adding those days together to come up with a total now of 152.66%. Here's the total number of days. All you have to do is add the up days and down days. And then there's 253 years roughly in a year, 253 trading days in a calendar year. And so if you go through and do all the math, this is what your annualized return comes out to for these periods. Now, if you look at every day since 1950, the annualized return is about 9%. And that's, excuse me one second. I think it's still allergy season down here in South Carolina. Anyway, if you look since 1950, every day and go through this formula, you'll see the annualized return is 9%, a little over 9%. And that's pretty consistent with the annual return, the average annual return, which is right around 9%. If you go back to 1950, add them all up and divide by 71. So if every day was created equal, we should see roughly 9%. I mean, over time, we're now 71 years in. You'd think that, we got enough data where, 9%, we ought to be somewhat close to 9%. But if you look at these periods where you run up into earnings season, you see that end of December into the early part of January, 24.55% annualized return. April 1st, April 18th, we just saw it again this year, 31.94% annualized return. That's the best pre-earnings period. June 28th to July 17th, 26.6%. And then October 1st to the 18th, 15.3%. All of these numbers are significantly higher than this 9%. And it's over the course of a lot of days. I think all of these samples are statistically relevant. And so you take the total of all the pre-earnings, all 4 of these, add them together, and you come up with 56.6% of the days move higher and 24.54% the annualized return. This is over a span of 4,200 days. You divide that, that's probably about 17 years worth of data. That 17 out of the 71 years has generated 24%. So if you look at, well, what happens outside of that period, the balance of the year, this 56.6% chance of the market going higher any particular day drops down to 52.48%. So right here. And there's your annualized return over the other 50 some years, 53 years, 54 years, whatever it is, 4.16%. All of a sudden that annualized return is not very impressive. But that hopefully illustrates that Wall Street adage, buy on rumor, sell on news. This is performance prior to earnings season kicking in. Really important to understand how the market likes to work. You think, well, my company came out with great earnings. Why is it down? Well, a lot of times it's simply because it's already been built up. The market has already been buying, and you just simply run out of buyers. Those who wanted to buy have bought. And those who chase, that's all that's left. There's no accumulation. It's just folks seeing the news and just chasing what's already happened. And those are the ones that usually get caught. So you want to be careful and realize that most of your earnings gains come in the early part of earnings season before the numbers even start to come out. Really important. And so I went on to point out too, and I've talked about Zoom a lot. Probably folks are getting a little tired of me talking about Zoom. I still really like the company, and they do have earnings coming up on June 1st, and perhaps we're getting a pre-earnings run here. We'll see. Now, notice back, the prior, we got a run up in February, pulled back, and then with earnings, we had this huge gap up, couldn't get a breakout, and then failed. So, use that as history to maybe help gauge how the market is treating Zoom, both prior to earnings and then after earnings. What I would like to see after earnings is to see the company gap up and actually hold above these last few months, start to turn this chart around. But anyway, I just want to point out they're going to be reporting soon. The other one is Elastic, which when you look at I'm going to show you a daily chart. Let me see. Let's go over here. I mean, if you look at this daily chart, you never think, at least I wouldn't be looking at potentially buying. I mean, you see maybe even like a little bit of a head and shoulder pattern, left shoulder, head, right shoulder over here, neckline coming across. You can see it's been trading below the 50-day moving average for the last few months. Growth stocks have been very weak. All these things are pointing to, more weakness. And we've just, risen up to the 50-day, and you can see we failed there last couple of times. So this would tell me we might want to be bailing on ESTC, not buying it. But when you look at the weekly chart, it does tell a different story. So we broke above this prior high at about 101, 102, came back down, tested the area, maybe went just a little bit below, broke to a new high, back to about that 100 level. all the way up to 180, got way ahead of itself. And then when the selling of growth stocks kicked in, it just went down with all the others. But it did have another nice reversal off of this 100 area. I think as long as the stock continues to trade over 100, I feel pretty good about it. And I believe we might get a run up to perhaps maybe even the 130 area heading into earnings. Now, ESTC reports on June 2nd. And if you look at the daily chart, you might want to have stop in play. If it does move toward 130, you would think that it's going to continue to hold this the prior declining 20-day moving average, which now is starting to turn. If we come down, bounce off of that 20 and then break back out above the 50, I would begin looking at this as more of a short-term uptrend. Right now, it's just a bounce. But, one of the things I look for to establish an uptrend is to come down, test that 20-day, and then break to a new high. And so that's what I would be looking for there. Anyhow, I wanted to point that out, the article from Saturday, if you didn't get a chance. Let's move on. I want to talk a little bit about options expiration. I mentioned that earlier in the show. Of course, Friday was option expiration Friday for the month of May. So we won't have that to consider for the next few weeks. But we talked about the spider potentially going down as low as, I think, it was 411.94 on Tuesday when we had our webinar. And we thought maybe it could go down to 401. So it was a directional move that we were looking for toward 401. We got down to 405. I mean, we did make that initial move down, and then the S&P came roaring back. The QQQ, though, 322 is where we were last Tuesday, and max pain there was 327.04. I just wanted to point out we closed at 327.01. I mean, almost right on max pain. That doesn't happen very often. Again, I'm looking more for directional movements. And after gapping down Wednesday morning, the NASDAQ was nonstop to the upside. And there were more in the money puts, meaning that market makers would actually eliminate a lot more premium on the QQQ if prices were to rise. And that's what we saw. Now, as far as individual longs go, we've mentioned three stocks, one being Magnite, MGNI, which at the time was 26.20. Max pain was 34.79. And I said at the time, or at least I believe I said, I would be shocked to see it go to 34.79. But any movement toward 34.79 is money that lines market makers' pockets. And after gapping down on Wednesday, look at what MGNI did. It got down to almost 25. And by Friday, it was up over 30. Really important to understand what options expiration is all about and the short-term market inefficiency that comes out of that. And that's all it is. If you're somebody buying the QQQ and holding it for months, or for years, I should say, just long-term buy and holder, doesn't matter what's going on around options expiration. It's a short-term market inefficiency. That's it. But anyway, you can see MGNI making a move to the upside. Now, VUSI was one that I expected would see a run. And we did gap down on, if you pull up a 5-day chart. So VUSI did gap down at the open on Wednesday, and it did recover back to over 17 by Friday morning, but then was down throughout Friday. So it actually finished a little bit lower from where we had talked about it. So this was the only one that I would say didn't work out of all of them that we talked about. Snap was another one on the long side that would benefit, from higher prices. And look at those last 3 days, those hollow candles moving up. So Snap was 53.36. Max pain was 56.78. It closed at 56.61. Then I gave out 4 shorts. One was AMC. It was 14.03. Max pain was 11.32. I even wrote a couple articles. I think I wrote about it in the daily market report last week for members on Tuesday. And then I also wrote about it in the Don't Ignore This Chart blog over at Stock Charts, I think later that day. But you can see the equal highs. So we had price resistance, and it behooved market makers. There was $36 million worth of net in the money put premium on AMC, call premium. net in the money call premium, where folks were expecting price to action to go higher. So what did it do? It went lower. I always call options expiration, to me, I don't know if you ever were a Seinfeld fan, but if you are, you'll probably remember that episode, Opposite George, where George, down on his luck, always a pessimist, finally starts trying things opposite. So whatever he normally would do, he went opposite, and things started changing in his life. Things actually started working out. It's a pretty funny episode. Anyhow, that's what I look when I think about options expiration. To me, it's like opposite George week, where just whatever you'd expect, whatever options players are looking for, you might want to be thinking about the opposite. And so AMC, you can see 1403 is where it was, and Friday's close 1208. The majority of that $36 million of net in the money call premium was wiped out. Wells Fargo, and I like Wells Fargo. I had it, I got out of it because of options expiration. Probably should have entered last week on this 20-day test, but I'll be getting back into it. I would guess this week, kind of see how it opens up and go from there. But Wells Fargo is at 46.86, had max pain at 43.55, and it closed at 45.88. Again, didn't go to 43.55, but the direction, it's a directional move that we're looking for. STLD, Steel Dynamics, 63.29. Max pain was 50.36. Obviously, it didn't go down to 50, but over the course of the next 3 days, it did go down a couple of bucks, saving some money. Mosaic, same thing. 36.47 was the price on Tuesday. 33.45 was max pain. It went to 35.46. So, and this was one, and I said at the time, I shorted it. I got out. I don't remember where I got out. I think I got out on Thursday. Not at the bottom, but probably 34.5, maybe 34.75. And that's one of the very, very rare times I will short during a secular bull market. I couldn't even tell you the last time I had shorted before that. And I held it exactly 2 days. And the big thing was not only max pain, but that reversing candle was just suggesting that the stock was going down short term. So I just had a fairly small position and just picked up a couple bucks or $1.50 and exited. Anyway, those were the stocks that we talked about. If you're not a member at Earnings Beats, this is, I think, one of the really significant things that we do every month for our members is go through and point out during options expiration week on that Tuesday before which stocks could see some opposite movement, could set up some nice trades, or like with Wells Fargo, if you own these stocks and you know that the options are saying that, hey, it could pull back, maybe you want to lock in profits in the near term. All of those things I think factor in. So anyway, I just wanted to point that out, make sure everyone has seen that. I'm sure our members are well aware of it, but those that maybe are new to Earnings Beats, this is one part of our service that I think is maybe an overlooked part, but one that's pretty important. And the webinar always is the Tuesday before the third Friday of the month. The third Friday of the month is always Friday, is option expiration Friday. So whatever that is, back up 3 days, Tuesday, we'll do that webinar. All right, moving on. How about scanning? I want to show you, if someone said to me, give me a list of your best stocks. I mean, I guess everyone might have a different definition of how you would find those companies. But I think, without actually going through the charts and just specifically pointing out, okay, I like this one, I like that one. I think the scan engine at Stock Charts is one way that you could quickly identify a fairly small group of stocks that meet a lot of the criteria that are important to you. Now, for me, from the research work that we do at Stock Charts and Earnings Beats, the lists that we keep at Stock Charts, but the platform that we do at Earnings Beats, strong earnings, raising guidance, those things are really important to me. If a company is beating top line, bottom line, and then raising guidance for the next quarter, fundamentally, I don't know how it can get any better than that, because those are the numbers that analysts are going to use to try to determine value of a company. they're going to have models, their growth forecasts, and they're going to be modeling. And if you can beat your estimates and then you say, hey, we beat our estimates and we're raising our guidance, I would think most analysts are going to be raising their price target on a stock. Maybe not that day, but maybe over the course of the next quarter. Why not that day? Well, they want to buy. They got clients they want to buy for. That's why a lot of times you don't see these raised targets when companies first come out with earnings. Some you will, probably those that have already bought heading into earnings. But those that hadn't bought are not going to come out and say, oh, we're raising guidance and then drive the price up for them to go out and start buying. It's not going to work that way. Anyhow, these are the three things that fundamentally I think make the most sense to me. Well, I say three, they're really two: strong earnings and raised guides. We just happen to have three chart lists. So what I've done here on this scan is I've written a scan so that I look into any stocks that are on either our strong earnings chart list number 1 or strong earnings chart list number 2. There are not going to be any companies that are on both. It's, once we ran out of room on the first one, we started putting companies into the second one. They're not going to be any of the same companies, or there shouldn't be. I shouldn't say there aren't, because there could be. Because of a company, some companies will report 2 months apart one time during the year. Like they'll report in May, and then they'll come back and they'll report instead of in August, they'll come back and report in July. So it's possible that they could be on both. But usually companies go off of our strong earnings chart list before they come out with their next report. And then if it's strong, meets our criteria, it goes back on. So usually there's no duplications, but there are exceptions because of when they report sometimes. Anyhow, this scan tells, this tells the scan engine to look to see which companies are, it can be on either one of these two. And and right there is really important, because it's either of these two lists, but it also has to be in the raised guidance list. And then also adding this one, Scooter needs to be above 90. That's the stock chart's technical rank, which is relative strength. And you can see here, if I run this scan, I will come up with 25 companies. So I would say that this is a pretty good list. Now, is this am I going to be buying every stock I own off of this list? No. But this is probably a pretty darn good list to start with. And you can sort it by Scooter. You can then, go in here and drop it. You can store these results in a new chart list, however you want to do it. But that quickly, using the information that we provided at Earnings Beats and using the scan engine at Stock Charts, that's how quickly you can find companies that beat Wall Street estimates, top and bottom line, raised guidance, and also have Scooters above 90. That's going to be a pretty strong list of companies. And you can see if we sort by sector, 6 discretionary, 4 healthcare, 5 industrials, 5 materials, a real estate, 4 technology. I mean, it's pretty widely diversified, many different industry groups as well. So, this is a group maybe to work off of. So I thought maybe you'd find that interesting. Let's keep moving, and I want to go next to earnings. There were nothing was out today. Just want to mention later this week, NVIDIA will be reporting. They come out on Wednesday. So if we look at the relative chart here, NVIDIA has been strengthening against the semis. We're at about a 5 or 6 month relative high. Volume picked up last week on some pretty good volume, on a pretty good move we saw on NVIDIA on some pretty good volume. And so we're making a run as earnings will be out in just a couple of days. Let's see what else. A couple of software companies, OKTA, Okta, sideways consolidating, really hasn't been doing much, down near 52-week low. Software has been weak. Will we get a lift from Okta? The market says probably not. We'll see. I think another one to watch is Viva Systems, VEEV, also in the software space, also going sideways, also not performing well relative to its peers. But still a number of bigger companies. Thursday, there are a lot of bigger companies, a handful of companies over 100 billion in market cap. So we do have some bigger companies coming out later this week. All right, last thing, 3 you must see. I'm going to start off with Goldman Sachs. Goldman Sachs, I think it's in a little bit of a triangle here off a move to the upside, consolidating above the 20-day moving average. I'm expecting it to break out. I'd watch maybe 350 price support along with the 50-day moving average, which it hasn't closed below in quite a while. But I think Goldman Sachs looks pretty good. I'm going to give you an update since we just opened the market. And we are up a buck on Goldman Sachs. Next up, Ford. Ford had a really nice week last week. Big move to the upside, trying to get back through this resistance area now. I think eventually we're going to get this breakout on Ford. I like it. You know, it looked like it was rolling back over and didn't look very good. See how it broke above the 20, and what I said earlier, when it comes back and holds the 20 and then breaks out again, that starts to make me think a stock is trending higher. Look at that PPO starting to strengthen above the 0 line. Now, we may fail because we do have resistance up near 1350. If we do fail, I like Ford on another test of the rising 20-day. That to me would be a really solid, low risk, high reward kind of a trade, where if it went back and closed below the 20, I get out. If it were to bounce back to the upside and clear, then I think I'd be catching it at the perfect time. Last stock is Boeing, BA. I wanted to mention this one because it got through the 20-day after trending lower for a while. You can see that failure at the 20 earlier in May. We closed above it on Friday, gapped up just a little bit this morning. It's down now fractionally, but I would watch that 20-day. If it holds and moves to a new high, that would be another pretty good sign for Boeing. All right, that's it for today. Let's just get a quick update on the market. Dow up 157, NASDAQ's up 86, S&P up 24, small caps up, mid caps up, VIX back down below 20. I'd like to see the VIX go back down and set a new low, recent low, which would probably require 16. I don't remember how low we got, but I think it was 16, 17. That would be a very bullish sign for the market. Otherwise, we may just be in this back and forth for a little while. May typically is not very good until we get to the 26th, which is coming up later this week on Wednesday. The 26th of May through about June 5th is a very bullish period for the market. So keep that in mind as we start working our way toward June. All right, that is it. Everybody have a great day. Appreciate you stopping by. I'll be back tomorrow over at Stock Charts TV for a recorded version of Trading Places Live. Hope you can make it. That'll start at 9 a.m. Eastern. You just go over to stockcharts.com and then click on the Stock Charts TV at the top on their menu bar, and you can tune in on Tuesday. Everybody have a great day. I'll be back tomorrow. Happy trading.